Hello and welcome to this session. This is Professor Farhat. In this session, we're going to look at the Capital Project Fund and what is the Capital Project Fund and how do we do accounting in the Capital Project Fund. In the next session, we would look at the debt service funds and we'll see how we deal with the debt service fund. So what is a Capital Project Fund, or I'm going to be calling it as CP, not A, F. F is in Frank. Okay, let's go ahead and get going. What's the definition of a capital project fund? It's a fund. As you know, the fund is a separate entity that accounts for and report financial resources. So notice, in the capital project fund, we are keeping track of our resources, and those resources are legally and contractually required for the acquisition of capital asset. So basically what we are doing, we are keeping track of certain resources, usually money, certain resources that we have a specific purpose for those certain resources. What's that specific purpose? Is to acquire the capital asset. Now, I'm going to say this one more time. We don't keep track of the asset itself, of the capital asset. We don't keep track of the capital asset because the nature of capital asset are long-term. And remember, this is a governmental fund. And remember, in governmental fund, we don't have long-term assets and long-term liabilities. So only we keep track of the resources, which is usually the money and some related activities to that money. So the purpose, so what's the purpose of the capital project fund is to ensure and demonstrate that the expenditure of the dedicated financial resources is both legally and contractually compliant. Remember, government accounting deals a lot with legal and contractual compliance. Therefore, the purpose of the fund is to serve that purpose, is to make sure the expenditure are going to the right place, which is in our situation, it's going to be to a capital project. So the total cost of a capital project is accumulated in a single expenditure account, which accumulates until the project is completed, at which time the fund ceases to exist. So what's going to happen as we spend money on that project, we're going to keep that expenditure in a fund, and once the project is completed, that fund will cease to exist. The other thing we want to know about the fund, it has a project life, not a year life. So when we have a project, it's not like it's going to take a year or 2 years. It's that project, whatever that project is. It may take us 1.5 years. It may take us 3.25 of a year. So the life of the fund is based on the project itself, not time-based. Little bit more about the capital project fund. So the government must maintain capital project fund for resources, again, that are legally restricted or committed or assigned. So sometimes we say restricted, sometimes it's committed, or sometimes it's assigned. Whatever the situation is. Remember, the basis is modified accrual accounting. When do we use full accrual? We use it for governmental wage, which we'll see later on when we reconcile the two. But we use modified accrual. And there are generally two types of capital project. Also, there are two types. I'm just going to say always one type. There is the capital project that benefit the public. Examples will be public buildings. For example, the city would like to build the hall, roads for everyone, highways and bridges, park improvement, sewer systems, plant and equipment. Those are examples of capital projects. We have what's called special assessment or private benefit. Those are projects that benefit citizens in a specific benefit district. This will include street improvement. And we talked about those special assessment taxes where we fix the street, but we charge the citizens a special tax. It's called special assessment, curbs, sidewalks, street lighting, sewage, but those that benefit specific people, therefore we charge them specifically taxes for those services. So let's start to do some accounting for the capital project and a capital project fund, and specifically the acquisition. So basically, how does it work? Okay, assume that Simple City proceeds with the creation of a capital equipment replacement. So they would like to have a fund that deals with capital replacement funds. So once their vehicles, their snow removal machines, the trucks that spread salts on the street, every once in a while they'll need to replace them. So what's going to happen maybe every 5 to 7 or 10 years? What they're going to do, they're going to create a fund for that. What's going to happen is, the first to create the fund, we're going to need to transfer money from the general fund. So to create the fund, the general fund, the transfers, this means to give without the expectation of repayment of $1 million to that new capital replacement fund. So on the general fund We're going to credit cash because we pay out cash, $1 million. Obviously, we credit cash. We debit basically other finances uses. So basically uses. It's like, I'm not going to say it's an expenditure, but it's basically they're using cash. Cash is being reduced. So this account goes on the revenues and expenditure statement. So basically, it's an income statement account. But it's not expenditure. It's other financing uses. General fund is using cash. Now, the capital project fund, they're going to accept the cash, happily accept the cash. Obviously, they will debit cash. They will debit cash $1 million, and they will credit an account called other financing sources for $1 million, which is the type of the account is other financing sources / uses, which is also a revenues and expenditure account. So other financing sources goes on the revenues and expenditure account. Obviously, the uses, they're going to reduce the fund balance. Other financing sources, they're going to increase the fund balance. Now, on the government-wide financial statement, we don't do anything. Now, what happens if we are going to construct a capital asset? Okay, we're going to go through what's called the 3 phases to show you how the process works, but it's not really much. It's just common sense. The capital project fund, when we're going through when we are constructing an asset, let's assume a building or a bridge or a road. The process goes through 3 phases. The first phase is the pre-construction phase. We haven't started the construction. What do we do during this phase? During this phase, we're going to outline the project. We're going to outline the project, maybe have a blueprint for everything. Then we're going to try to find out what is our financing option. Try to get our financing authorization. How are we going to finance this project? And we're going to see this what happened in phase 1. Phase 2, we're going to do the actual construction. And phase 3, if we borrowed money in phase 1, we're going to service the debt servicing phase. Let's start with phase 1. Phase 1 is the financing. Basically, how are we going to arrange the financing? How can we arrange the financing? Well, we have more than one option. The first option is to basically issue bonds. Issue bonds. But you have to know when the government issue bonds, what they do, they impose taxes. So they want to raise $2 million. They would issue the bond, but they will find a place to tax the citizens to raise this money. Therefore, it's called tax-supported debt. So it's a tax that supports the debt. That's basically what it is. So it's basically a general obligation. Simply put, a bond, and we'll talk about bonds a little bit more. A general obligation or special tax is restricted to the payment of bond. So this is one way for them to raise money. Another way for them to raise money is through grants. What's a grant? Basically, another government, let's call it a generous government giving you the money. Okay, another general government or other form of financing such as special assessment. Okay, now. Type 1, tax-supported debt. How does the tax-supported debt work? Well, the first thing we need, generally speaking, we're going to need the voters' approval. Why? Because we're not going to impose taxes without their approval. So we need the voters' approval. Then we have a memo entry for bond tax authorization. Basically, once we have the authorization, we're going to have a memo, basically a record saying that we can issue the bond. Now the proceeds means when we receive the cash. So we're going to debit cash, obviously. We're going to debit cash $5 million and accounted for as other financing sources. What we're going to do, we're going to credit other financing sources. Other financing. My pen is acting up. Just give me one moment, please. Other financing sources, $5 million. Okay, so this is where we put the money. This is where we put the proceeds from the bond. Now, what's going to happen is this. The difference between the face value of the bond. Remember, the bond will have a face value. Okay? For example, the bond will have, I should use something other than 5 million. I'm going to use 10 million because there's an example. We're coming up with 5 million. So let's assume 10 million. What's going to happen? The 10 million is what we call is the face value of the bond. Face value is 10 million. Simply put, we want to borrow 10 million. So what's going to happen if we'll try to borrow 10 million? Well, we might have what we called issue cost. What's issue cost? Well, to sell the bond, we're going to need help. We're going to get help from what we call the broker, dealer, or investment banker, because they're gonna have access to investors, they're gonna have access to lenders, therefore they will be easy for them to sell the bonds for us in order for us to raise the money. So that issue cost, it's gonna be considered an expenditure. So we are going to treat that any issue cost as an expenditure, because the issue cost is simply, it's an expenditure. Okay, it's a cost of selling the bond. So that's gonna be that's gonna create a difference between the face value and the cash received. Maybe we want 10 million, but we might have to pay $50,000 or $100,000 for the issue cost. Now, we also, when we sell a bond, we might incur a premium or a discount. Now, it's important to understand how the premium and the discount work. So let me go ahead and explain this. Now, most probably this is bringing flashback from intermediate accounting. If that's the case and you don't remember what a premium and discount is, please go to my intermediate accounting channel, intermediate playlist. Okay, and you have a list of all my intermediate accounting, which in turn you'll talk about premium and discount, but I'm going to explain premium and discount now. So how does premium and discount work? So let's assume the government wants to borrow money, $10 million. What they do is they go to the market and they tell the market, we would like to borrow $10 million. $10 million. All right. So before they borrow the $10 million, they have to tell the market. So that's how much they want to borrow. They have to set interest rate, willing and able. This is how much they want to pay. So this is not going to work. So they're going to set interest rate that they are willing and able to pay. So for the simplicity of this example, we're going to assume this government can pay 6%. Okay, so let's assume we have one borrower. They would like to give them the money. So the borrower will give them $10 million now, and they would receive every year 6%, which is $600,000 per year. That's fine and dandy. So the company is not the company. The government is paying 6%. We call this 6%. We call it offering rate. We call it coupon rate. We can call it contract rate. We can call it nominal rate. Let's see if there's any other names. We can call it, what else? What else? Coupon, offering, contract, nominal. I usually call it printed rate to remind you that it's printed and it's not fixed. It's fixed. It doesn't change. So this is I'm going to call it here coupon rate. Okay, 6%. Now, when you want to sell this bond, you're going to go to the market, and the market is competitive. So the market overall, they want their own rate. So the market will set their own rate. So the market means similar bonds to you they're paying a certain rate. So similar bonds to you, let's assume they're paying also 6%. If similar bonds to you are also paying 6%, that's usually not the case, but if that's the case, if similar bond to you are paying 6%, then your bond will sell at what we call the par value. Par value or face value. In that situation, you would actually receive $10 million. Okay, let's keep on going with this example. Let's assume we're going to keep the coupon rate as the same. Remember, it's printed, it's fixed rate, and the market is paying 4%. Here what happened, this government is paying 6%, and everybody else in the market for similar bonds is paying 4%. What's going to happen? Everyone's going to rush to buy your bond. Why? Because this bond is paying $600,000 per year, and everybody else is paying $400,000. Government similar to you. So what's going to happen in that situation? Your bond would sell at what we call the premium. Premium means you would receive more than $10 million. Why? Because you are willing to pay more in interest. The market would reward you by giving you more when you sell your bond up front, because supply and demand, you're going to have more demand for your bonds. You can sell it at a premium. This is when the bond sells at a premium. Also, the bond could sell, you're offering 6, and the market is paying 8. Well, guess what here? No one's going to buy your bond for $10 million. No sane person or rational person will do it. Why? Because they can go to the market and receive, rather than 600,000, they can go to the market and receive 800,000. So under those circumstances, your bond would sell at a discount. Simply put, you would receive more money, less money than the 10 million. Okay? This is what we're trying to say here. Now, having said so, when we say this bond is sold at a premium, what we say it means you received more money than what you wanted to raise. You received more money what you wanted to raise. If we say your bond sells at a discount, it received less money than what you wanted to raise. You wanted to raise $10 million. You could not raise $10 million. Why? Because your rate was not competitive. So when we see it's selling at a premium, selling at a discount, that's all what you have to know for now. But again, as I told you, if you're really interested in learning about bonds, okay, this is good enough so you survive in this course. But if you really feel, I really don't understand bonds, I suggest you go to my intermediate accounting playlist and view it, and you can view the whole recording. Okay, now let's take a look at an example and see how it actually works when we issue bond at a premium. So assume that bond with a face value of $500,000. So the government wants to sell bonds for $500,000. Were issued at 101. Well, again, we have to explain this. Bonds are quoted as 97, 100, 101, 101.5. This is how prices are quoted. 101 means what? It's 101%. So it says 101, this is 101%. This is the price of the bond. So to find out how much did we receive, we're going to take $5 million multiplied by 1.01, and that's going to give us 5,050,000. This bond sells at a premium. Simply put, anytime the price of the bond is more than 100, it's a premium. Now all what we know is it's sold at a premium. All what we know is this bond is paying more than the market. That's all what we know. And that's all what you need to know for now. Okay? So the capital project fund will debit cash $550,000, credit other financing sources bond proceeds $500,000, which is other financing sources, and they will credit other financing sources bond premium. So notice we account for the premium and the bond separately. We account for the premium and the bond separately. Now, if you were using accrual accounting, which is intermediate accounting, you would debit cash, credit bonds, credit premium. Okay, this is what you do on the governmental-wide financial statement. Eventually, you're going to have to reconcile those two, but this is just showing you how it works. Now, not most government, what you would do, because this 50,000 was extra, here was extra, what's going to happen, the government will transfer this 50,000. They will get it out of the capital project fund, because this was basically extra money. So what we do is we'll debit this account, we'll debit other financing sources premium for 50,000, and what they do is they would remove it to the debt service fund, due to debt service fund. Due to debt service fund. And why did we do this? We want to take it out of the capital project fund, because we received this extra money, and we want it to do what? We want it to go to the debt service fund and eventually help us pay our debt down, because this 50,000 is extra. So this is basically what we do. We transfer it to the debt service fund. Let's look at a grant, type 2 type of. Assume approval is obtained from the for a federal grant as a partial funding for a city office building project. So what's going to happen? The federal government is going to give us some money as a grant. Upon approval, once the federal government approved the grant, what we do is we debit due from governmental unit, which is kind of a receipt, it's a receivable, and we credit revenue. Now, on the government-wide financial statement, we'll do from governmental unit, and we credit program revenue, which is also revenue. Very similar, both revenue and receivable. Okay. the amount due from the federal government for the previously recorded capital grant was received in full. So once we receive the money from the federal government, we credit the receivable and we debit cash. Excellent. Now we have the money. And the same entry, obviously, under the government-wide financial statement. Okay. Type 3 of financing, other form of financing, special assessment. This is when we levied when taxpayers in an area beyond their jurisdiction wanted to benefit from certain facilities and services. I always give the example of snow removal. You live in an area where the city doesn't plow the snow because you're on the outskirts of the county. So what's going to happen? You'll pay special tax, and the government will go ahead and provide you the service, but you have to pay extra for that. Okay. Additional topic for capital project fund, interim financing. What's interim financing? Interim financing, when you need money you haven't started the project yet, but you need some money. So it may be necessary to obtain interim financing until the proceeds from the intended source, like a bond or the grant, are received. What you do, used often to complete architect and engineering design during the pre-construction phase, because you need money. You haven't started the financing. Where are you going to go? You're going to go to the general fund. You're going to ask the general fund, the government, to give you money. So assume for the office building project, $50,000 was borrowed from the general fund. Notice it says borrowed, to be repaid later. So what we do is we debit cash, credit to, which is a payable, due to general fund. Now the general fund obviously will debit. So the general fund, okay, will debit due from, which is a receivable, capital project fund, 50,000, and they will credit cash 50,000. This is what the governmental fund will do. Okay. Okay. So the 50,000 due to the general fund was repaid. When they repaid them the money, they will debit the payable, which is, this is a payable. So the capital project fund will debit the payable and they credit cash. The government fund, they will debit cash. They will debit cash 50,000 and they will credit due from, which is a receivable, 50,000, due capital project fund. Okay. Budgeting, now bear in mind, budgeting help ensure control, because that's the purpose for budgeting. So since the capital project fund have project, not period focus, it may be unnecessary to make annual budget. So you don't have annual budget because the project is not annual. It's based on a project. So when you are building a road, it may take you three and a half years. So it's not every year you will do the budget again. You will do the budget right from the get-go. But since numerous projects are integrated into a single fund, budgetary account help control individual project expenditure. Now, a lot of time the government would have many capital project funds. So not one, they will have many. So each project, and it's better to have each project under a different fund. This way it's easier to control. So GASB require budgeting over integrated funds when control cannot be established by other means. That's fine. All right, let's look at a budgeting example. A contract was let in the amount of 50,000 with an architect firm to complete the architect design for the new city office. Remember, we borrowed that money from the general fund. Now we did hire the contract. The following entry would be required in the capital project fund. What we do is we encumbered 50,000, remember encumbrance, and we credit reserve for encumbrance. This way, we basically sign, we kind of assign the agreement with the contract. That's all what we did, okay? Encumbrance. We encumbered the account. Obviously, under governmental funding, there is no encumbrance. Now, the architect firm, for which an encumbrance of 50,000 has been recorded, tendered its final billing in the amount of 48. So what they said it's going to cost you 48,000 for us to draft the architect design. The city immediately paid the amount. Therefore, what we do first, we have to reserve the encumbrance. So we have to reverse the encumbrance, and this is to reverse the encumbrance, to remove the encumbrance. Then we're going to debit construction expenditure and credit cash for 48,000. Now, government-wide financial statement, they will debit an asset called construction in progress, or CIP. This is the government-wide, and they will credit obviously cash because we paid cash. Okay. So this is about capital project fund. What's going to be in the next session? I will work a more comprehensive example about capital project fund. So it's going to be a longer example that's going to illustrate many topics, starting with the budget and ending up with financial statements. So I suggest you view the next session to learn more about the capital project fund example. Then after that, we're going to look at the debt service fund. If you have any questions, any comments, by all means, email me or see me in class. And if you're studying for your CPA exam, study hard.